I am about to tell you something that could save your retirement, something that the financial industry does not want you to hear because it would hurt their business, something that goes against the conventional wisdom that has been repeated so many times that people assume it must be true. There are 5 investments that millions of Americans own right now, investments that are considered mainstream and respectable, that could lose 50% or more of their value by 2026. Not speculative bets, not cryptocurrency, not meme stocks, investments that your financial advisor might have recommended, investments that are sitting in your retirement accounts right now. I have been in banking for over 40 years. I have run one of the largest financial institutions in the world through multiple crises. I have seen what happens when investments that everyone thinks are safe turn out to be anything but. And I am seeing the same warning signs today that I saw before previous disasters. This is not fear-mongering. I am not trying to scare you into some gold scheme or survival bunker. I am trying to give you the honest assessment that I would give to my own family, the assessment that you deserve, but are not getting from the people who profit from keeping you invested. Let me walk you through these 5 investments, explain why each one is in danger, and tell you what you can do to protect yourself. The first investment that could lose 50% is long duration treasury bonds and the funds that hold them. I know this sounds impossible. Treasury bonds are backed by the United States government. They are supposed to be the safest investment in the world. How could they lose half their value? Here is how. Bond prices move inversely to interest rates. When interest rates rise, bond prices fall, and the longer the duration of the bond, the more it falls. A 30-year Treasury bond loses approximately 20% of its value for every 1% increase in interest rates. We have already seen this happen. From 2021 to 2020, 3 long-term Treasury bonds lost over 40% of their value. The supposedly safest investment in the world dropped by 40%. Most people do not even know this happened because they were focused on the stock market. Now here's the danger. Interest rates could rise further from here. The United States government is running deficits of nearly $2 trillion per year. That money has to be borrowed. The national debt is over $34 trillion. Interest payments on that debt now exceed $800 billion per year. At some point, the market may demand higher interest rates to keep lending to a government that cannot control its spending. If 10-year Treasury yields rise from 4.5% to 6.5%, long-term bonds will lose another 20 to 25%. If yields rise to 8%, which is not historically unusual, long-term bonds could lose 40% or more from current levels. Combined with the losses that have already occurred, we are talking about total losses of 50 to 60% from the peak. For an investment that people thought was safe, the popular ETF that tracks long-term treasuries, TLT, has already fallen from over $170 to around $90. It could fall to $60 or $50 if rates keep rising. Millions of retirees own this fund thinking they are being conservative. They are actually sitting on a time bomb. If you own long-duration Treasury bonds or bond funds with average maturities over 10 years, consider selling them. Move to short-term treasuries, treasury bills, or money market funds. These are genuinely safe because they mature quickly and can be reinvested at higher rates if rates rise. Long-duration bonds are a trap in this environment. The second investment that could lose 50% is commercial real estate, particularly office buildings and the REITs and funds that own them. The commercial real estate market is in the early stages of a collapse that most people do not yet understand. The pandemic permanently changed how we work. Companies have discovered they need less office space. Employees have discovered they prefer working from home. This is not a temporary disruption. This is a permanent structural change. Office vacancy rates in major cities are at record highs, 20%, 25%, in some areas 30% or more when buildings are empty. They do not generate rent. When they do not generate rent, their owners cannot pay their mortgages. When mortgages go unpaid, the properties are foreclosed and sold at distressed prices. We have already seen trophy office buildings in major cities sell for 50 to 70% less than they were worth a few years ago. Buildings that were valued at hundreds of millions of dollars are selling for a fraction of that. And this is just the beginning. Over the next 2 years, hundreds of billions of dollars in commercial real estate loans will need to be refinanced. The borrowers will not be able to refinance because the properties are worth less than the loan balances. Banks will foreclose, properties will sell at distressed prices, the losses will cascade through the system. The REITs that own office buildings are in serious danger. Many of them are already down 40 or 50% from their peaks. They could fall another 50% from current levels as the crisis deepens. Dividend cuts are coming. Some REITs may not survive, but it is not just office buildings. Retail real estate is also struggling as e-commerce continues taking share from physical stores. Even apartment buildings in some markets are facing pressure as oversupply and rent declines hit landlords. If you own commercial real estate REITs, especially office REITs, you need to seriously consider selling. If you own private real estate funds or partnerships, understand that the values being reported may not reflect reality. Try to redeem if you can before the gates go up. The only commercial real estate that looks relatively safe is industrial and warehouse space that benefits from e-commerce, and data centers that benefit from cloud computing and artificial intelligence. Everything else is suspect. The third investment that could lose 50% is regional bank stocks. The regional bank crisis of 2023 was not a one-time event. It was a warning of deeper problems that have not been resolved. Many regional banks are sitting on massive unrealized losses from bonds they bought when interest rates were low. Many have heavy exposure to commercial real estate that is declining in value. Many are facing deposit outflows as customers move money to larger banks or to money market funds paying higher yields. Silicon Valley Bank, Signature Bank, and First Republic were not unique. They were just the first dominoes to fall. Other regional banks have similar problems. They just have not been forced to recognize their losses yet. The Federal Deposit Insurance Corporation has estimated that unrealized losses on securities held by American banks exceed $500 billion. That is $500 billion in losses that are sitting on bank balance sheets, hidden because accounting rules allow banks to pretend the losses do not exist as long as they do not sell the securities. But banks cannot hide forever. As deposits flow out, banks have to sell securities to meet withdrawals. When they sell, they realize the losses. When they realize the losses, their capital is impaired. When their capital is impaired, regulators step in. And when regulators step in, shareholders get wiped out. The CRE ETF, which tracks regional bank stocks, has already fallen significantly from its peak. It could fall another 50%. If we see another wave of bank failures, individual regional bank stocks could go to zero, as shareholders of Silicon Valley Bank and First Republic discovered. I am not saying all regional banks will fail. Many are well managed with strong balance sheets, but distinguishing the good from the bad requires deep analysis that most individual investors cannot do. The safest approach is to reduce exposure to the entire sector. If you own regional bank stocks either individually or through ETFs, consider reducing your position. If you have deposits at a regional bank, make sure you are under the FDIC insurance limit of $250,000. Consider moving some money to one of the largest national banks that are considered too big to fail. The fourth investment that could lose 50% is unprofitable technology stocks. The era of free money is over for more than a decade. Interest rates were near zero. Investors were willing to fund any company with a good story, regardless of profitability. Revenue growth was all that mattered. Profits were considered old-fashioned. That era ended when the Federal Reserve started raising rates in 2022. Suddenly, money had a cost. Suddenly, investors started caring about profits. Suddenly, companies that had never made money found that capital was no longer available on easy terms. We have already seen massive carnage in unprofitable technology stocks. Many SPACs and recent IPOs have lost 80 or 90% of their value. Some have gone bankrupt, but there is more pain to come. Many technology companies are still burning cash. They are still promising that profitability is just around the corner. They are still trading at valuations that assume everything will work out perfectly. It will not work out perfectly. It rarely does. The companies I am most worried about are those with negative free cash flow, high stock-based compensation, and business models that have never been proven at scale. Companies in sectors like electric vehicles, fintech, food delivery, and speculative software, companies that raised money at inflated valuations during the boom and are now struggling to justify those valuations. As these companies run out of cash, they will have to raise more money at much lower valuations, diluting existing shareholders, or they will have to cut costs dramatically, which may undermine their growth stories, or they will simply fail. I am not talking about the technology giants, Microsoft, Apple, Google, Amazon. These companies are enormously profitable with fortress balance sheets. They will be fine. I am talking about the hundreds of smaller technology companies that went public during the boom without ever demonstrating a path to profitability. Look at your portfolio if you own individual technology stocks. Check whether the company is actually generating positive free cash flow. Not adjusted EBITDA, not non-GAAP earnings, actual cash flow that exceeds what they are spending. If they are not, you are betting on a turnaround that may never come. If you own technology-focused ETFs or mutual funds, look at what they actually hold. Many of these funds are stuffed with unprofitable companies. The broad market index funds that are weighted toward the profitable giants are much safer than the growth-focused funds that chased momentum during the boom. The fifth investment that could lose 50% is cryptocurrency. I have been skeptical of cryptocurrency for years, and nothing has changed my view. Bitcoin and other cryptocurrencies are not currencies. They are not stores of value. They are speculative instruments whose prices are driven entirely by sentiment and momentum. Cryptocurrencies have no intrinsic value. They do not generate cash flows. They do not produce anything. They are not backed by anything. Their value depends entirely on the belief that someone else will pay more for them in the future. That is the definition of speculation. We have already seen multiple cryptocurrency crashes. Bitcoin fell from nearly $70,000 to below $16,000. Many alternative cryptocurrencies fell 95% or more. Some went to zero when the projects behind them collapsed or were revealed as frauds. No cryptocurrency is in another speculative cycle. Bitcoin has risen back above $90,000. The believers are saying this time is different. They said the same thing before every previous crash. The factors driving this cycle are the same as before. Speculation, momentum, fear of missing out. The approval of Bitcoin ETFs has brought in new buyers who do not understand what they are buying. When the sentiment turns, and it always does, the new buyers will panic and sell. I expect Bitcoin to fall at least 50% from its peak at some point in the next 1 to 2 years. Alternative cryptocurrencies will fall even more. Some will go to zero. The exchanges and platforms that facilitate cryptocurrency trading will face stress, and some will fail, taking customer assets with them. If you own cryptocurrency, understand that you are gambling, not investing. The money you have in crypto should be money you can afford to lose entirely. If losing your crypto allocation would affect your retirement or your financial security, you have too much. Consider reducing your exposure or eliminating it entirely. The risk reward is not favorable. You are taking enormous risk for speculative gains that may never materialize. There are better places to put your money. Now let me explain why all 5 of these investments are vulnerable at the same time. This is not a coincidence. There is a common thread connecting them. The common thread is the end of easy money. For over a decade, central banks held interest rates near zero. They printed trillions of dollars through quantitative easing. Money was essentially free. This free money inflated prices across the board. Bond prices were inflated because rates were artificially low. Real estate prices were inflated because borrowing was cheap. Technology valuations were inflated because capital had no cost. Cryptocurrency prices were inflated because speculative money was everywhere. Now that easy money is ending, interest rates have risen to 5%. Central banks are shrinking their balance sheets. Capital has a real cost again, and all the distortions created during the easy money era are being corrected. This correction is not over. We are in the middle of it. The assets that were most inflated by easy money, long-duration bonds, commercial real estate, regional banks loaded with low-rate securities, unprofitable technology, and cryptocurrency are the assets most vulnerable to the correction. The correction could happen gradually, with these assets slowly declining over the next 1 to 2 years, or it could happen suddenly triggered by some shock that causes panic. Either way, the destination is lower prices for assets that were inflated by free money. Let me talk about what you should do to protect yourself. First, audit your portfolio. Look at every investment you own and ask whether it falls into one of these 5 categories. If it does, make a plan to reduce or eliminate that exposure. Second, prioritize safety over returns. In this environment, the first priority is not making money. The first priority is not losing money. Cash in short, term treasuries paying 5% is an attractive alternative to risky assets that could lose 50%. Third, focus on quality. If you own stocks, own profitable companies with strong balance sheets that can survive any economic environment. If you own bonds, own short duration, high quality bonds that are not sensitive to interest rate changes. If you own real estate, own properties in strong markets with stable tenants. Fourth, maintain liquidity. Do not lock your money up in investments that are hard to sell. Private funds, illiquid partnerships, thinly traded securities, these can become traps when markets turn. You want the ability to sell if you need to. Fifth, diversify across asset classes and geographies. Do not have all your money in one type of investment. Do not have all your money in the United States. Spread your risk so that no single disaster can devastate you. Let me also talk about timing, because I know people will ask when exactly these investments will fall. I do not know exactly when. Nobody does. Markets can stay irrational for longer than you expect. These investments could continue rising for months before they fall. They could fall tomorrow. The timing is impossible to predict. But here is what I know. The conditions for a significant decline are in place. The vulnerabilities are real. The risks are elevated. Waiting for the perfect moment to sell is a fool's game, because you will not recognize the perfect moment until it has passed. If you believe these investments are vulnerable, and I have given you the reasons why they are, then reduce your exposure. Now do not wait for confirmation. Do not wait for the decline to start. By then, everyone else will be trying to sell too, and you may not get out at a good price. The best time to reduce risk is when markets are calm, when you can sell in an orderly way, when you have time to think clearly about your decisions. That time is now. Take advantage of it. Let me address the counter-arguments, because I want to be fair to the other side. Some people will say that treasury bonds are backed by the government and therefore cannot lose value. This is wrong. The government guarantees that you will receive the principal at maturity. It does not guarantee the market price before maturity. If you need to sell before maturity, you can lose money. If interest rates rise, you will lose money. Some people will say that commercial real estate will recover as the economy grows. Maybe eventually, but the structural changes from remote work are permanent. Office demand is not coming back to pre-pandemic levels. The oversupply will take years to work off, if it ever does. Prices have much further to fall. Some people will say that regional banks are oversold and represent good value. Some individual banks might be, but the sector as a whole faces serious challenges that have not been resolved. The risk of owning the wrong bank is catastrophic. The potential reward does not justify the risk. Some people will say that unprofitable technology companies will eventually become profitable and their stocks will recover. Some will, most will not. Picking the winners requires deep expertise and significant luck. For most investors, the risk is not worth taking. Some people will say that cryptocurrency is the future of money and will eventually be worth much more, maybe. But even if you believe that, you should acknowledge that the path to that future will include many more crashes of 50% or more. The volatility is inherent to an asset with no intrinsic value. Most people cannot handle that volatility and will sell at the worst time. I am not saying these counter-arguments are completely wrong. I am saying that the risks are real and significant, and most investors are not being compensated adequately for taking those risks. The prudent course is to reduce exposure and wait for better opportunities. Let me close with a thought about regret. There are two types of regret in investing. The regret of missing out, when you sell something and it goes higher, and the regret of losing money when you hold something and it goes lower. Most people think these regrets are equally bad. They are not. Missing out on gains is painful, but you still have your capital. You can invest it elsewhere. You can try again. Losing money is worse because the money is gone. You cannot try again with money you no longer have. For someone over 60, for someone approaching retirement or already retired, the regret of losing money is far worse than the regret of missing gains. You do not have decades to recover. You cannot earn it back through working. The money you lose is gone forever. This is why I am warning you about these 5 investments. Yes, they could go higher from here. Long-term bonds could rally if rates fall. Commercial real estate could stabilize. Regional banks could recover. Unprofitable technology could find its footing. Cryptocurrency could reach new highs, but they could also fall 50% or more. And for the reasons I have explained, I believe the odds favor decline. The risks are elevated. The conditions are unfavorable. The easy money that supported these assets is gone. Given those odds, the prudent course is to reduce exposure, to take the risk of missing out rather than the risk of losing money, to prioritize preservation of capital over the chance of gains. That is my message. That is my warning. I am not telling you to sell everything and hide in a bunker. I am telling you to look at these 5 specific investments and honestly assess whether you are comfortable with the risk of losing half your money. If you are not comfortable with that risk, act. Now sell before the decline. Move to safer investments. Protect your capital and, if I am wrong, if these investments rally instead of falling, you will have missed some gains. That is a tolerable outcome, much more tolerable than watching your retirement savings cut in half because you ignored the warning signs. Take this warning seriously. Look at your portfolio today, make the changes you need to make, and then sleep well, knowing that you have protected yourself from what could be coming. The next 12 to 24 months will reveal whether I am right. I believe the evidence strongly supports my view. But even if I am only partially right, even if only 2 or 3 of these investments fall significantly, you will be glad you took action. Protect your family. Protect the wealth you have spent a lifetime building. That is more important than any potential gain. That is the message I want to leave you with. Now let me go deeper on each of these investments because I want you to fully understand the mechanics of what could go wrong, starting with long-duration treasury bonds. The math here is unforgiving. Bond prices and interest rates have an inverse relationship that is governed by pure mathematics. There is no escaping it. There is no way to hedge it away. If you own a bond paying a fixed coupon and interest rates rise, your bond becomes less valuable because new bonds offer higher coupons. The duration of a bond tells you approximately how much it will move for a 1% change in rates. A bond with a duration of 20 years will lose about 20% if rates rise 1%. A bond with a duration of 30 years will lose about 30%. Many investors do not understand this. They see treasury bonds as government-backed and assume they are safe. But government backing only protects you against default. It does not protect you against price declines while you hold the bond. And in an environment where rates can rise significantly, those price declines can be devastating. The question everyone should be asking is whether rates will rise from here. I believe they could for several reasons. First, the government needs to borrow enormous amounts of money. Nearly $2 trillion per year in new deficits, plus rolling over existing debt as it matures. That is a lot of bonds that need to find buyers. If demand does not keep up with supply, prices fall and yields rise. Second, foreign buyers are purchasing fewer treasuries than they used to. China has been reducing its treasury holdings. Japan has been selling to support its currency. Other countries have their own fiscal challenges that require capital at home. The marginal buyer of treasuries is increasingly domestic investors and the Federal Reserve. Third, inflation could prove stickier than people expect. If inflation settles at 3 or 4% instead of the Fed's 2% target, interest rates will need to stay higher to provide positive real returns. The bond market will demand compensation for inflation risk. Fourth, there is a growing concern about the sustainability of U.S. fiscal policy. At some point, investors may lose confidence in the government's ability to manage its debt. If that happens, a risk premium gets added to treasury yields, pushing them higher. Any one of these factors could push rates higher. All of them together could push rates significantly higher. And if that happens, long-duration bonds will suffer. Let me also expand on the commercial real estate situation because the depth of the problem is not widely understood. Commercial real estate was financed during an era of low interest rates. Developers and investors borrowed at 3 or 4% to buy properties, yielding 5 or 6%. The spread between the borrowing cost and the property yield made the deals work. Now borrowing costs are 6 or 7% or higher. Properties that yielded 5% no longer make economic sense at those financing costs. There is no spread. There may even be negative carry where the borrowing costs exceed the property income. This means that properties cannot be refinanced at their current values. A building that was worth $100 million when rates were low might only be worth $60 million when rates are high because a buyer paying higher financing costs needs a lower purchase price to make the returns work. The owners of these properties face a terrible choice. They can sell at a loss, recognizing the decline in value. They can try to refinance at a lower principal amount, which requires coming up with cash to pay down the difference. They can hand the keys back to the lender and walk away. Or they can try to extend their existing loan and hope that rates come down before they have to deal with reality. Many owners are choosing the last option, which is why the crisis has unfolded slowly. Banks are cooperating with extensions because they do not want to recognize losses either. This is called extend and pretend, and it has delayed the reckoning. But extend and pretend cannot last forever. At some point, the loans must be dealt with. At some point, the properties must be valued honestly. At some point, the losses must be recognized. That point is approaching as more and more loans come due over the next 2 years. When the losses are recognized, they will cascade through the financial system. Banks that made these loans will suffer. REITs that own these properties will suffer. Private funds that invested in commercial real estate will suffer. The investors who own shares of those banks, those REITs, and those private funds will suffer. The losses in commercial real estate could ultimately total hundreds of billions of dollars. We are talking about a crisis that rivals the savings and loan crisis of the 1980s or the housing crisis of 2008. It is unfolding in slow motion, but it is unfolding. Let me also provide more detail on why regional banks are particularly vulnerable. Regional banks have two major problems. First, they hold securities that have declined in value due to rising interest rates. Second, they have heavy exposure to commercial real estate loans that may not be repaid. The securities problem is straightforward. Banks bought treasury bonds and mortgage-backed securities when rates were low. Those securities have declined in value as rates rose. The banks are carrying unrealized losses that exceed their capital in some cases. Accounting rules allow banks to avoid recognizing these losses as long as they do not sell the securities. They can classify the securities as held to maturity and carry them at cost. But this accounting treatment does not change the economic reality. The securities are worth less than what the bank paid. The losses are real even if they are not recognized. The problem arises when the bank needs to sell. If deposits flow out, the bank needs cash. It has to sell securities to get cash. When it sells, it recognizes the losses. When it recognizes the losses, its capital is impaired. This is exactly what happened to Silicon Valley Bank. Depositors withdrew money. The bank had to sell securities. The sales triggered losses. The losses destroyed confidence. More depositors withdrew, and in 48 hours, the bank was dead. The commercial real estate problem is more complex. Banks made loans to office buildings, retail centers, and apartment complexes. Many of these properties are now worth less than the loan amounts. When the loans come due and cannot be refinanced, they will default. Commercial real estate loans are a larger portion of regional bank balance sheets than they are for the largest national banks. The regional banks made these loans because they knew their local markets. But now those local markets are in trouble, and the banks are overexposed. Not every regional bank will fail. Many are well managed with conservative lending practices and strong capital. But some will fail, and identifying which ones are vulnerable requires deep analysis that most investors cannot do. The prudent approach is to reduce exposure to the entire sector. You may miss some gains if the sector recovers, but you also avoid the catastrophic loss that comes from owning a bank that fails. Let me provide more context on unprofitable technology companies because people often confuse the profitable giants with the speculative bets. When I talk about unprofitable technology, I am not talking about Microsoft, which generates over $70 billion per year in operating income. I am not talking about Apple, which generates over $100 billion per year. I am not talking about Google or Amazon or Meta. These companies are enormously profitable and have been for years. I am talking about the hundreds of smaller technology companies that went public over the past several years without ever generating profits. Companies that raised money on the promise of future growth, that spent lavishly on customer acquisition and product development, that never had to prove they could make money because capital was free. Look at the companies that went public through SPACs. Look at the recent IPOs. Look at the technology companies that are still burning cash after years of operation. Many of these stocks have already fallen 80 or 90%, but some are still trading at elevated valuations relative to their fundamentals. The challenge for these companies is that the path to profitability is harder than it looked. When you are growing quickly, you can tell a story about how profits will come once you reach scale, but reaching scale costs money, and money is no longer free. Many of these companies are now cutting costs, laying off employees, and trying to reach profitability before they run out of cash. Some will succeed, many will not. The ones that fail will see their stock prices go to zero. Even the ones that succeed may not see their stock prices recover. A company that was valued at $10 billion during the boom might be worth $1 billion after achieving profitability. The early investors who bought at inflated valuations will still lose 90%. The lesson is that valuation matters. Buying a company at any price just because it has a good story is not investing, it is speculation. And speculation usually ends badly for the speculators. Finally, let me expand on why cryptocurrency is so dangerous. Cryptocurrency has no intrinsic value. This is not a criticism, it is a statement of fact. A Bitcoin does not produce anything. It does not generate cash flows. It does not give you ownership of a productive asset. Its value depends entirely on what someone else is willing to pay for it. This makes cryptocurrency a pure speculative instrument. Its price is driven by supply and demand, sentiment and momentum. When sentiment is positive and money is flowing in, prices rise. When sentiment turns negative and money flows out, prices collapse. We have seen this pattern repeat multiple times. Bitcoin has risen dramatically, then fallen 70 or 80%, then risen again, then fallen again. Each cycle brings in new believers who are convinced that this time is different. Each cycle destroys those believers when the crash comes. The current cycle is being driven by several factors. The approval of Bitcoin ETFs has brought in institutional money. Speculation about interest rate cuts has increased risk appetite. Momentum has attracted momentum buyers who are chasing rising prices. But the fundamental reality has not changed. Bitcoin is still a speculative instrument with no intrinsic value. The factors driving this cycle are the same factors that drove previous cycles, and the outcome will be the same. At some point, sentiment will turn, momentum will reverse, and prices will crash. I am not saying Bitcoin will go to zero. It has survived multiple crashes and come back each time. But I am saying that anyone who owns Bitcoin should expect another crash of 50% or more at some point. That is simply how this asset behaves. The volatility is not a bug. It is a feature of an asset with no fundamental anchor for value. If you own cryptocurrency, you need to be honest with yourself about what you own. You are not investing, you are gambling. The money you have in crypto should be money you can afford to lose entirely. If that is not the case, you have too much exposure. Let me close with some thoughts on how to think about risk in the current environment. The investment environment we are in is fundamentally different from the one we had for the past 40 years. Interest rates are higher. Money has a real cost. The tailwinds that lifted all assets have become headwinds. In this environment, caution is warranted. Capital preservation matters more than capital appreciation. Avoiding losses is more important than capturing gains. The 5 investments I have warned you about: long-duration treasury bonds, commercial real estate, regional bank stocks, unprofitable technology, and cryptocurrency, all share a common vulnerability. They were all inflated by easy money. They are all vulnerable to the normalization of monetary policy. I am not saying you should sell everything and hide in a bunker. I am saying you should honestly assess your exposure to these 5 categories and ask whether you are comfortable with the risk. If you are not comfortable, reduce your exposure, move to safer investments, hold more cash in short-term treasuries. Focus on quality, prioritize survival over speculation. The next 12 to 24 months will be revealing. We will see whether the risks I have described materialize or whether I am wrong. Either way, you will be glad you took the time to think carefully about your portfolio and make deliberate decisions about risk. That is my message. That is my warning. Take it seriously. Protect yourself and be prepared for whatever comes next.